What's going on, guys? Welcome to one of Fortune 500. This will be the last episode for the company conEdison, and I'm gonna talk about valuation, dividend assessment, and my overall thoughts of the company. I'm gonna start with the valuation. Valuation is the last part of the fundamental analysis. When we talk about valuation, we have in mind valuation of the share price or market cap of the company. The different ratios put revenue, net income, cash flow, and many others in proportion with the share price. When we know the answer of the ratios, we compare the result with that of the different companies of the same sector and with the average ratios for the industry. And with that, we can conclude whether the company is over or underestimated. But one ratio is never enough, and the other parts of the fundamental analysis, profitability and debt management, are just as important as valuation. I will present to you three metrics regarding the valuation of the company. The first one is price to sales ratio. We use that ratio to assess how many times we overpay the sales of the company to buy one share. The average PS ratio for the industry is 3.4. So, in order for us to calculate that metric for conEd, we have to divide price, which is the market cap of the company of 33 billions by 15.6 billions of revenue for the last year, and we get 2.11. That means that compared with the competitors, conEd is priced below average, which means that the company is undervalued in terms of its sales. The next ratio is price to earnings ratio, which is one of the most popular ratios for evaluating price of the company. We get it by dividing market cap by net income for trailing 12 months. The metric represents how many times we overpay the earnings of the company. Generally, we want smaller number than the average of the industry because that will mean that the company is undervalued and we want to buy that kind of companies. The historical average for S&P 500 index is 15-16. For the industry that conEd is possessed, that ratio nowadays is 23. Historically, PE ratio of that industry is below 15-14 because of the small growth of the companies. But nowadays they are priced expensively. We divide 33 billions of market cap to 2.4 of net income for trailing 12 months and we get 13.75 PE for conEd. However, we have to put that in context. As a result of the sale of one of their subsidiaries, which I mentioned in the previous episodes, the net income for the first quarter of 2023 was 1.4 billions. That is extraordinary because that's almost the same as the whole 2022 net income. That's why the net income for trailing 12 months is so high number, because that number is generated by non-operating income, by the sale of asset. If we subtract that 1 billion extra, we get 2021 PE, which is a very different number. This is why PE is not always the best metric, because the bottom line or net income can be substantially higher, and thus the PE will become lower number and we will think that the company is undervalued. But if we dive more deeply, we will see that this is not the case. So, conEd is neither overvalued nor overvalued by its earnings. The company is just fair priced. The last metric regarding the valuation is price to book value ratio. Book value is the same as shareholders' equity. They are synonyms. So, that's the capital of the company. And as you already know, book value equals total assets minus total liabilities. When we know book value, now we can calculate price to book value ratio. That equals market cap divided by shareholders' equity. The number that we get has to be below 3 in order for the company to be fairly priced regarding the shareholders' equity. Otherwise, the company is considering overrated. So, the ratio expresses how many times we overpay the book value. In the case of conEd, we have to divide 33 billions of market cap and then divide it by 20 billions of book value, which equals 1.65. So, in terms of its book value, conEd is fairly priced and even undervalued. And by getting all that metrics regarding valuation, I will say that the company is slightly undervalued, and by adding the future prospect of the company, it makes the situation really interesting. I quickly mentioned to you in previous episodes that the company pays dividends, and for that reason I want to present to you one metric about the dividend of the company. The company pays dividend of 3.4% yield. The one metric that estimates whether the company is in good position with its dividend payments and whether that dividends are stable is dividend payout ratio. This ratio equals dividends payments divided by the net income. So we know that dividend of the company is 1 billion for the last year, and by dividing it to the net income of 1.6 billions, we get 0.62. And by multiplying that number by 100, we get it in a percent. So that ratio presents to us how much of the net income generated by the company goes for dividend payments. In that case, it is 62%. We want that number to be below 60%. That will mean that the company will have a room for upgrading the dividend and that the dividend is very stable when it's not that big of a percent from the net income. In the case of CONED, that ratio is 62%. That result for conEdison is optimal. It is optimal because the industry has a slow growth and generally the corporations try to offset that slow growth by paying bigger percent of their net income to shareholders. So with the dividend payout ratio of 62%, CONED is fine. It can be a little bit smaller percent, but still it is good. It is normal for that kind of company with such a long history to reach a point when the corporation has to pay big percent of its net income in the form of dividends. Also, the company has a history of 49 consecutive years of dividend increases, which is astounding. One more year of dividend increase and the company will be a dividend king. Dividend kings are the companies that provide increasing of the dividend for 50 straight years or more. conEdison is one more year to turn itself into that. So overall, in terms of the dividend, the company is in great position. We can't ask for better dividend operations. And finally, generally speaking, I really like the business of the company because the humanity will always have a need of the services that the company delivers. Also, I really like the fact that the company operates in New York, which is one of the best economic regions in the world. That region and the fact that the company is regulated provides stability. In terms of the future, that's the thing that I like the most. The rate increases, the opportunities for profit from EV plugs and other green energy projects are as good as we can imagine. Based on the fundamental analysis, I think that in my opinion, the company is a little bit undervalued, but the debt has to become lower and the profitability has to become a little bit better. After the company finishes with the aggressive investment policy, its attention has to be in that direction. Overall, I will finish with this. If you want a stable company with stable dividend payments of 3.4% for a year, combined with good yearly growth of 5 to 7%, which results in 8 to 10% yield per year, this is your company. The stock don't give you opportunity for 100% return like growth stocks, but also the company will not crush 50, 60, 70% at bad macroeconomic times like growth stocks usually do. So you have to evaluate your risk tolerance and make adequate decisions. This was all for this episode, guys. If you get knowledge and value, I will really appreciate if you hit the like button, subscribe to the channel and leave a comment. Have a wonderful rest of your day.